Welcome to Yahoo Finance Live. I am Shauna Smith along with Dave Briggs. It is certainly an ugly day here for the markets. Let's get you up to speed with everything you need to know. 3 p.m. Eastern Time. Fed Chair Jay Powell rocking markets after signaling that interest rates are likely to be higher for longer. We will break down exactly what he said and what it means for your portfolio.
Plus, Norfolk Southern outlines new safety measures in the aftermath of a second train derailment in Ohio. Are the plans too little too late? We'll ask the vice president of the union representing the workers later in the show.
And the Senate unveiling a bipartisan bill that aims to restrict access to TikTok. But what does it all mean for Zuckerberg and Meta, and which tech name could potentially be the biggest winner? We will discuss that with a top Wall Street analyst. But first, let's begin with the selling action that we are certainly seeing in the equity market today. You're looking at the Dow off 573 points. The drop here coming following a hawkish tone from Powell. Powell's testifying before lawmakers earlier today, reiterating the fact that we could see higher rates, and the higher for longer environment is putting pressure across the board here with equities. The Nasdaq off just around over 1%. The S&P back below 4,000, a critical level there for the S&P. You can see it off just about 1.5%. Pulling up the intraday chart, you can certainly see all three actually of the major averages right around the lows of the day as we head into the final hour of trading. Let's take a look also at the bond market action. The 10-year yield pushing to the downside here, but the 5-year yield actually pushing to the upside. Some gains there. The 13-week, though, is what I want to focus on. Obviously, a pop here following those comments from Jay Powell. The 2-year yield hitting 5%. That's the highest level that we've seen since 2007. Let's also take a look at the VIX here. The VIX popping on some of the uncertainty out there, exactly what the next couple of months could potentially look like here for the markets in the face of those higher rates. You're looking at the VIX just below 20. Let's take a look at the sector action. All 11 of the S&P sectors in the red, all off over 1% right now. The worst performers, financials, the XLF off just around 2.5%. Real estate materials not too far behind. Digging deeper into some of the selling that we are seeing, you can certainly see Merck, the only stock in the Dow right now holding on to gains. The worst performers, though, JP Morgan off just around 3%, and Goldman Sachs also off about 3%. Now, financials typically do better in that higher rate environment, but some worries about a recession certainly weighing on some of those big names. And it's not only the larger bank names, certainly we are seeing pressure across the board when it comes to some of those regional plays as well. Inside the Nasdaq, a lot of red as the larger cap tech names under pressure, names like Tesla off just around 2%. You're looking at Google off about 1.5% today. So lots of red on that screen, matching my dress.
Ugly. I was just going to point that out. Thank you for doing so. That is what happened. Here is why. Fed Chair Jerome Powell kicking off his 2-day congressional testimony today. Powell making it clear that interest rates will go higher for longer as economic data indicates a still strong economy.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
While the Fed has previously mentioned that there was still a long way to go to reach the central bank's desired 2% inflation goal, Powell did say that he is starting to see some signs of disinflation.
There's little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions.
Now, things certainly did heat up. Senator Elizabeth Warren put Powell on blast, asking him to respond to the millions of Americans that could lose their jobs from these interest rate hikes.
If you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
Now that was interesting, and she went on, Elizabeth Warren, to say, Shauna, that you are gambling with people's lives, and if you can't fight for the American people, there's only one solution. That's for us to find someone who will, at least insinuating that they need a new Fed chair. That is clearly not the job of the U.S. Senate. I'm fairly certain Elizabeth Warren knows that, but that's a whole nother issue. What was also fascinating is who agreed with her. Arguably her polar opposite in the Senate, Senator John Kennedy from Louisiana, with a similar line of questioning to Powell. Listen.
When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
Okay, so Shauna, are they playing politics here, trying to get Jerome Powell to say, yes, I need 2 million Americans to lose their jobs in order to bring inflation down to 2%? Or is there a bit of a fundamental misunderstanding of how this process ought to work?
I think it's a combination of both, actually. I think they are playing the blame game. They want to place the blame on somebody if, in fact, we do see job losses. On the flip side, though, we've heard time and time again, even on this program a number of times, that we don't necessarily need to see a massive job loss here in the U.S. in order to get inflation under control. We can steadily add jobs, not at the rate, clearly, that we have been adding them over the last 3 months. We've added just about 1 million jobs here to the U.S. economy, really putting that job accretion in perspective here, but we don't have to see massive losses. Mark Zandi, Moody's Analytics chief economist, was on with us last week saying he doesn't think we need to see massive pain in the job market in order to get inflation under control. I think right now the market's just reacting to that hawkish rhetoric that we have heard from Powell, similar to what we have heard in the past, but really doubling down, saying that more rate hikes are likely on the table. We could be in that environment, that higher rate environment, for longer than maybe the market wanted to anticipate, wanted to think, leading into the testimony today. But we're going to get more tomorrow. And I think this is just reconfirming, or really confirming, everything that we have heard from Fed Chair Jay Powell at his last couple of conferences.
It's important testimony, not to lessen the impact. It will be tomorrow in the House. But what matters? Jobs number Friday, CPI Tuesday, PPI Wednesday, and that's what Powell is watching. Has been data dependent from the start. All right, let's take a deeper dive into the Fed Chair Powell's testimony before Congress, what it means and why it matters for everyday Americans. Joining us now is Michael Gapin, Bank of America Head of U.S. Economics, and Troy Gajewski, Chief Market Strategist at FS Investments. Michael, we'll start with you. And your biggest takeaway from Powell's testimony today?
I think it's a pretty straightforward takeaway, which is the door is open for a faster pace of rate hikes, or the return to a 50 basis point hike in March. But will the data walk through? Right? That's essentially it. He said if the totality of the data justifies a faster pace, we'll certainly deliver that. And as you just mentioned, there's a series of data points between now and March 22nd, including JOLTS, the employment report, CPI, PPI, retail sales. So there's enough there that if it clears the proverbial bar, the Fed will switch back to 50. If the data softens up, the Fed will likely do 25. So I do think it is dependent on what's before us between now and March 22nd. I'm not sure it's penciled in firmly just yet, but certainly Powell left the door open for it. And if the data walks through, the Fed will respond. That's my main takeaway from today.
So Troy, break all of this down for us, the investor out there, why they should care so much about what Powell had to say in front of lawmakers today, and then the top trades from an environment like this, that higher for longer interest rates that Powell has been talking about time and time again.
Yes. So bottom line is, investors continue to pine for the days of 2009 to 2021, where, every time there was a problem, the Fed had ride to the rescue with lower rates and more quantitative easing. And, Powell reminded everyone today that, look, if you're buying equities in the S&P at 18 and a half times forward earnings, based on 23 rather paltry earnings estimates, you're playing with fire because we're in a much more sustained inflationary environment. Obviously, they're going to hike more in the front end, more than likely 75 basis points, but they have left the door open to more. And they're still tightening the balance sheet and draining money supply. So we're just in a very different investment environment than 09 to 21. We're not going back to those days anytime soon. So in general, as an investor, you want to focus on protecting capital, take less risk, maturely accept low returns, somewhere in the mid to high single digits, and make sure you don't get carried away with bear market rallies, particularly chasing them. And then in terms of top ideas, look, it depends on the strategy. Alternatives are now democratized, so you can do things like senior secured commercial real estate debt. You can embrace daily liquid multi-strategy solutions that have that, what we refer to as Northwest Quadrant efficient frontier return profile. But if you're going to have to take risk and embrace more volatility, then you should do it in securities that throw off a tremendous amount of income. Whether you look at mortgage REITs or you look at listed BDCs that trade at significant discounts to NAV, when you're earning a 13, 14, 17% dividend yield, you can stomach a lot of volatility, but you will have volatility and there will more likely be more downside in price. And then secondarily, look, if you look medium to long term, one of the few things you can be confident in the next 5 to 7 years is we'll continue to underinvest in commodity production and energy production. And so that creates a higher floor for the commodity complex. We're much less confident in demand, particularly in the short term. But if you have a longer time horizon, that's a sector that one could focus on as well.
Okay, and Michael, to the narrative that we alluded to about the labor market, I laid out two options, and I think Shauna laid out a third. And one is they just wanted Jerome Powell to say 2 million Americans need to lose their jobs for 2% inflation, or they don't understand the labor market, or three, we can get there without a dramatic spike in the unemployment rate. Which is the case?
So we would be surprised if we got inflation all the way down to 2% without removing some of the imbalances in the labor market. History does suggest that the amount of disinflation that we're looking for would require some softening in the labor market and some rise in the unemployment rate. How much, of course, remains to be seen. Most of us are thinking a moderate rise in the unemployment rate. So we have it rising to 4.7 or 4.8%. That's still well below what would be a 30-year average unemployment rate. But there's a big persistent imbalance between labor demand and labor supply. And that is one of the factors helping to keep inflation elevated. So we come down on that side of it, but the pandemic is a very different cycle. It's not inconceivable that inflation could fall more rapidly without needing to lean on labor markets heavily. I would just be surprised if that were the case. So I can't rule it out, but I think history tells us some softening in the labor market is likely in store.
Troy, what do you think?
Yeah, so look, 3% should probably be the Fed's new target, but they're still stuck on 2%. It is unlikely that unemployment doesn't go up, at least materially. But yeah, that 4.5 to 5 range makes a lot of sense. But again, if you think of the big picture here, the big picture is, the labor market continues to do exceptionally well. The nominal GDP continues to grow at a very rapid rate, while financial assets are taken on the chin, which is really a complete reversal to the days of quantitative easing. And the term we have for it is galactic mean reversion, where not only do financial assets struggle, but you still have a remarkably stable labor market. And the silver lining from the pain that's been taken in financial assets more recently after a bear market rally in late October and early January is that the longer the labor market remains resilient, you keep pushing back in recession risk, and it allows the Fed to have time to gradually at least bend it down to 4 to 3. Whereas if instead we were headed for a hard landing, that would create much more labor market pain. And so it's really a great time to be a worker and not as good of a time to be long only equities and long only fixed income.
So Michael Powell did say that the path to lower inflation is likely going to be bumpy. Your best guess a scenario here at the end of the year, what do you think that inflation level will likely look like?
I think somewhere, I mean, our forecast would have it a little above 3%. So let's just say 3 to 3.25, around 3.25 by the end of the year in terms of what the year-on-year rate of inflation would be at the end of this year. But just remember, we're still in the mild recession camp. So we still think later this year, the economy would slip into something that looks like a traditional recession, and that weakness in demand would be one of the factors helping to bring inflation down. In a soft landing forecast, it may be that inflation stays firmer for longer. But to answer your question, something a little above 3% is where we think we're headed by the end of 23.
All right, Michael Gapin, always great to have you. Troy Gaske, you too. Thanks so much for joining us here to break down the latest comments that we're getting here from Powell. All right, well, we are just getting started on Yahoo Finance Live. Coming up, more cuts are coming to Meta. The Facebook owner is reportedly planning another round of layoffs that will affect thousands of employees. We will break down what lies ahead for the social media giant. Then we are approaching a tip-off for the battle over NBA rights. Who is going to take the crown? We will get one analyst take. And later we are talking the state of the movie industry with IMAX CEO Richard Gelfond. All that over the next 2 hours. Don't go anywhere. Meta planning another round of layoffs this week. That's according to reports from Bloomberg. Now, the move would add thousands more to the 11,000 workers that were cut from the social media giant last November. It is the latest in a tech industry that has certainly seen a massive contraction over the last several months. Here to break down how the major players are navigating this and who's coming out on top, Yahoo Finance's tech reporter Ali Garfinkel has that for us. Hey, Ali.
Hi, Shauna. So while I'm not a teacher, I want to break this down report card style because these companies are all in incredibly different positions. I want to start with Apple, who is at the top of the pack with an A. Now, Apple's earnings were actually not standard Apple. We actually saw a rare miss out of them this last cycle. However, there's a key number that's really important here for how things are looking, and it's 2 billion devices. That is how big their install base is. I believe that's more than 20% of the world's population. So the iPhone install base is at an all-time high, and it's sending the company's services revenue to a record of $20.8 billion. What does this all amount to? It says that analysts say that this bodes extremely well for Apple's future as they increase how much individual users spend. So not a standard quarter for Apple, but there is a lot of good news there. So we'll give them an A. Maybe we'll fudge it to an A-. Now, next is Microsoft. So Microsoft will get a B. Slight top line beat, slight bottom line miss, but they won the ChatGPT lottery. Now, while their cloud growth is slowing, it slowed to about 31%, just barely beating analysts' expectations. That $10 billion investment in ChatGPT came at exactly the right moment. So we're going to give them a B for foresight. Next, Amazon. Revenue beat, earn an EPS miss. Amazon has a lot to prove here. They're really doubling down on cost cutting, and I'm giving them a C because of that cloud number. Amazon Web Services net sales came in missing. It was a 21.3 billion actual versus 21.76 billion expected. Now, that doesn't seem like a big miss, and to be fair, it is not. However, that has been a stalwart. AWS has been a stalwart of Amazon's business for so long that it is very important that they keep that growth up or come up with a new plan. And last, we have Meta, which is going to get a C. Yes, they beat key revenue expectations, and there are growing losses on the Reality Labs operation, hence the C. However, they are investing in a $40 billion stock buyback plan, and they're betting that this year of efficiency, this cost-cutting plan is going to work. I'm withholding judgment for now, but they are certainly ready to bet on themselves. Of course, now Meta being in the news because they're reportedly set to do another round of layoffs that could affect thousands and could come as early as this week. That said, Meta is the only one we know is doing layoffs for the time being. However, given Jerome Powell's testimony earlier today that rates will continue rising, the macroeconomic climate that has been so difficult for so many of these companies will continue to be difficult. So we'll have to see how they navigate it moving forward.
Very good. So, Ali, you mentioned the ChatGPT lottery being won by Microsoft. Let's shift to the other one, which is the TikTok ban boost, if you will. Who stands to benefit the most? Because you're young and I'm old, and because you're our tech reporter, is it YouTube Shorts, therefore Google? Is it Meta with their Reels? Or is it even Snap, who's seen a really solid pop to start the year? Who's the closest to emulating it in terms of social media style?
That is a really good question, Dave, and I'll be candid. I think there are a couple of different answers, and we would have to have that whole scenario play out to really know who the winner is. That said, I'm going to actually throw my hat in on Snap here. Every analyst I've ever spoken to who's bullish on Snap has one key argument, and it's that it is essential for teenagers. And if that's like something TikTok has become known for, it's certainly something Snap is known for, definitely on Wall Street, and to be fair, among the teenagers I've talked to. So I'd say if there's anyone who's set to really benefit, I would put money on Snap. That said, YouTube Shorts is something Google has massively invested in. Meta has been preparing for the moment where hopefully TikTok is less of a competitor for a long time. I think we could see a massive shift in the competitive landscape, but I would say the biggest beneficiary could be Snap, and market certainly seems to think so.
That's an interesting take, because I sat at a Celtics game with a 15-year-old the other day, and he was on Snap the entire time, not TikTok.
The kids love it.
So yeah,
The
they
kids
really
love
do.
it.
I'm curious to
They
see where
love
they
it.
go from here. Ali Garfinkel, thanks so much. Good stuff. All right, coming up, Norfolk Southern CEO is set to testify before a Senate committee about rail safety after that large freight train derailment in East Palestine, Ohio. We'll talk to one union leader about what he wants to happen next.
Let's do a quick market check here. We're just around the lows of the session, not too far from those levels. We have the Dow off 538 points, S&P off 1.5%, the Nasdaq off just over 1%. This is part of a market check sponsored by Tasty Trade. A lot of the losses having to do with the hawkish rhetoric that we heard from Fed Chair Jay Powell in front of lawmakers earlier this afternoon.
Renewed questions about rail safety and regulations after a second Norfolk Southern train derailed over the weekend. In the latest, 28 cars slid off the tracks, though no one was injured. But East Palestine, Ohio, still assessing environmental and public health conditions as a result of burning toxic chemicals in the wake of that February 3rd derailment. Brotherhood of Locomotive Engineers and Trainmen Vice President and National Legal Representative Vince Turner is here with us. Vince, nice to see you. Ohio Congressman Mike Turner called this truly outrageous what's happening. What is happening with our nation's rail system right now?
Well, unfortunately, I think that in the recent past, we've seen a lot of deregulation fever that has swept through the sort of industry in recent years. And I think that unfortunately, despite warnings over many years that taking away safety regulations was a bad idea, we're starting to see that these accidents come home to roost, so to speak. I'm very, very glad that the most recent accident, there were no fatalities. The men and women that I represent, the locomotive engineers and trainmen, they're a very, very professional, world-class workforce. And what's happening now, I think we could really use more regulatory oversight. And that's really what we're seeing right now.
Vince, what would that regulatory oversight look like? I know you recently met with Transportation Secretary Pete Buttigieg. What can you tell us about those conversations and exactly what you think needs to be implemented from a regulatory perspective?
Well, the Department of Transportation and the Federal Railroad Administration right now they've taken some positive steps, one of which is a notice of proposed rulemaking on minimum crew size standards, a two-person crew regulation that has to have one certified engineer and one certified conductor in the cab of a locomotive. That will not prevent every accident. That it didn't prevent the one in East Palestine. But what we've seen over and over is the evidence suggests that after one of these accidents happens, having more than one person on a crew helps to mitigate the scale of the disaster, because if you have mobile people on the crew, they can separate the train at cars that are not tank cars that aren't on fire from ones that are on fire, and it helps lessen the disaster itself. Other things that are happening right now is that they're taking another look at legislation. There's a bill by Senator Brown and Senator Vance being advanced that would raise the fines on railroads from the current cap, which I think is around $225,000, which the railroads are multi-billion-dollar corporations. That type of low fine cap is really just like a slap on the wrist to these companies.
Interesting. You mentioned the impact of deregulation here. How has the national employment shortage impacted the rail industry as well?
Well, the employment shortage in the rail industry, we really believe is sort of self-inflicted by the industry's adoption of a rapid, really extreme cost-cutting business model called precision scheduled railroading. It's really driven away a lot of employees because railroad employees work without a regular schedule. Most of them go to work on call as far as the operating employees that we represent. And so the employment picture is, the precision scheduled railroading basically took employment down 30% in a matter of about 2 years. And it's really affected not just safety, but it's also affected service. But because of the cuts in regulation that have coincided with this cost-cutting business model, I think we're seeing more risk injected into the industry, unfortunately.
And Vince, is that risk across the board? Or when you look at Norfolk Southern, their safety record, they have a long list of accidents, even just going back over the last 4 or 5 years. Is Norfolk Southern an outlier, or is this an industry-wide issue?
Well, I don't think Norfolk Southern is an outlier, but I would be quick to point out that the risk that is in the industry would go across the board pretty much with the Class 1 railroads that have the scope and size of a railroad like Norfolk Southern. So while I think there's a lot of attention that has been rightly paid on Norfolk Southern, the other Class 1 railroads, all of these deregulatory efforts that we've just talked about, all of the railroads, the Class 1 railroads, have pushed for these deregulations and are benefiting from the fact that they were able to prevail with the oversight agency at FRA to get regulations rolled back.
Okay, Vince Verna, got to leave it there. Brotherhood of Locomotive Engineers and Trainmen, really appreciate your insights there. Thank you. Coming up, shares of WW International are soaring today on its new business strategy. We'll tell you why the company is betting big on telehealth on the other side of the break.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Starbucks, Weight Watchers, and Dick's Sporting Goods. Kicking it off with Starbucks, founder and CEO Howard Schultz is no longer refusing to testify before the Senate Health, Education, Labor, and Pensions Committee over the company's labor practices. Now, committee chair Senator Bernie Sanders announcing earlier today that he's, quote, happy that Schultz finally agreed, in his words, to appear. Senator Sanders is investigating a number of complaints that Starbucks violated federal labor laws under Schultz's leadership. Now, on Twitter earlier today, Senator Sanders wrote, quote, "I look forward to hearing from him as to when he intends to end his illegal anti-union activities and begin signing fair first contracts with the unions." Now, Starbucks employees have been voting to unionize at very quick speeds here. In just the past 2 years, employees at more than 280 locations have done just that, with calls for better pay and benefits and also improved safety conditions. Now, even though they have voted to unionize, those unions have yet to reach an agreement with Starbucks. So Schultz under fire there from many of these employees that have voted to unionize, getting some pressure also from certain members of Congress. We'll see what he has to say later on this month.
Yeah, I'm curious how he's going to come across, because this is a very sensitive subject right now and something that we're seeing throughout corporate America. Amazon pushing for unions, Disney pushing for unions. Starbucks is not alone in this. Apparently, Starbucks' general counsel wrote to the committee that another executive should testify and not Schultz, since he'll be stepping down as interim CEO this month. But Sanders very adamant that he wanted it to be Schultz, considering his policies have been the one that's really been criticized. And if you take a look back, since Schultz took over last April, there has been this big non-union push with raising wages and benefits for non-union members. So again, we'll have to see how he comes across.
Two big questions as he's out the door, to your point. One is related to unions, and the other one is related to olive oil. And that's the real question I have.
That's what everyone wants to get to the bottom of.
Unions will hash this out. I'm not sure where that eventually goes, but this Oleato line of olive oil infused drinks from
We've got to try
Howard
it.
Schultz and Starbucks, well, we don't have access to them yet. That just sounds like an odd pairing that I can't quite swallow, but we are going to try to make it here. What's your vote? I mean, yay or nay? Sounds like a nay.
Nay, yeah.
Allie?
I feel like I get my
wanna
olive
like
oil
it.
in other places, like my salads. I don't need it in my coffee.
Well, I bet you that we will be proven wrong. I bet you it's going to be good.
I bet you it tastes good.
I did
Starbucks
try-
is very smart.
Well, you remember when there was that butter in coffee trend?
Oh, yeah, that was a big
I
trend,
liked that one. I was a big fan
It's
of
a
that
whole
one.
thing, right?
They didn't do it at
Get the
Starbucks.
fats up, and it's related to my triple play, because this
There
is
we
all
go, the
about,
fats up. I get
I love a
That's what I
good
was trying to do.
transition. My triple play is Weight Watchers International. The stock is surging, oh my goodness, up almost 70% today after the company announced it's buying digital health company Sequence. Sequence is a subscription service that offers telehealth visits with doctors, and the move represents a new strategy play for the business, which will supplement its food tracking and wellness services with weight loss drugs like the viral Ozempic. In a statement, Weight Watchers CEO said in part, quote, "As science advances rapidly, we know there is a significant opportunity to improve outcomes for those using medications. It is our responsibility as a trusted leader in weight management to support those interested in exploring if medications are right for them." I don't know, guys, this feels counterintuitive to me. I thought the whole point of Weight Watchers was to lose weight organically, and now we have these weight loss drugs.
Hey man, they are hopping on a very profitable train here, so I get it from that perspective. We didn't see the word Ozempic there. We didn't hear Wegovy, which is another. We didn't hear Mounjaro, which is yet to be FDA approved. But that is it might be the biggest drug to hit the market in the next 10 years, people are saying. And why? Because we are getting fatter. That's just the fact. The World Obesity Federation says by 2035, more than half of the world's population will be obese. That just came out a few days ago. The United States is north of 42%. There is some caution with these drugs, though. Not only do you have to stay on them forever, or completely change your lifestyle and your eating habits, which very few are doing, or the other aspect is there's a massive shortage, so it's not clear how much they're gonna be able to profit from it. You can't get your hands on it, no doubt. It's a profitable business if we can produce enough.
It's a profitable business. I'm not shocked. I am shocked to see the stock jumping as much as it is today when it comes to Weight Watchers. But Allie, I agreed with you. I kind of took a step back. I had to reread exactly why they were making this acquisition, because it doesn't really make sense when you think that their entire business model has been to convince people that you can do it the healthy way. A lot of people would argue that just taking those types of drugs, weight loss drugs, is not doing it the healthiest way. But they need to do something else to boost their business. When you take a look at their member numbers, they declined quarter over quarter in the report that they put out last night, certainly trending in that wrong direction. We know this quarter is always very critical for Weight Watchers. A lot of people sign up for those weight loss programs at the start of the year, but I don't know. We'll see how this all plays out. I got questions.
Off of lazy Americans is what it is.
Eat healthy, work out, everyone will shed the weight.
And wear workout apparel, and buy that at Dick's Sporting Goods. So we're going to
Related.
continue to transition to my play, a trending ticker on Yahoo Finance, which is Dick's Sporting Goods, putting some big points on the scoreboard today. Shares surging more than 10% on a very strong Q4 earnings beat. Dick's same-store sales increased 5.3%, more than double analyst estimates. Guidance also topped expectations. Net sales up more than 40% from 2019. That's pre-COVID. Their CFO, Navdeep Gupta, explained that approximately 80% of the company's sales growth compared with 2019 driven by growth in footwear, athletic apparel, team sports, and golf. So we are getting in shape, some of us. Thus far in earnings season, the story has been about the cautious consumer, but that does apparently not apply to sporting goods and sporting apparel. I guess you can compare this closely to a shift from goods to services in that this is an experience. The consumer is still shopping on doing things. Maybe that's how you justify this, unless you just think they operated extraordinarily well.
Yeah, well, CEO Lauren Hobart, she justified it by saying that sportswear, this type of stuff is a necessity, not so much a discretionary spending. She's saying that people need to do this. The argument that she's making, that's why she said that we saw such a jump here. But clearly the improvement on inventory, I think, is what caught a lot of people, at least in terms of analysts on the street, by surprise. That improvement there, one of the big standout parts of this most recent quarter. I have some questions, though, about the momentum, whether or not that's going to be able to continue here for Dick's Sporting Goods, given the fact that so many consumers are pulling back on spending. I need a little bit more of convincing.
Same source sales. Their net sales are up 40% from pre-COVID. And you're not convinced by that number.
That the trend's going to continue. I don't know. I think right now, at least for the holiday quarter, the sales were very strong. Whether or not people actually do view a lot of things that are sold in Dick's as necessity, not so much discretionary.
I can agree there.
I'm not convinced.
Found the
of
common thread.
I just think it's funny that sports is like the savior to all these sectors that are struggling. Cable, well, we have sports. Streaming, let's buy sports rights. Apparel, well, our sports inventory.
What have I been telling you for the last year?
My gosh, sport. It's like, people are obsessed. So that's
all
that
about
was my
sports.
biggest takeaway.
That's the big takeaway from Triple Play today. All right, Alec and Al, thanks so much. Well, coming up, a new bill that could pave the way for TikTok to be banned in the U.S. We will tell you who could potentially benefit from that potential ban next.
What we are trying to deal with here is the risks of insecure information and communication technologies, ICT. And whether that comes in the form of software, where oftentimes that software can provide backdoors into sensitive American intelligence and technology means, hardware, a la the Huawei equipment that, interestingly enough, was oftentimes sold into those rural markets where we had some of our national defense establishment, or social media platforms, where we've seen abilities to both collect data and present malign influence operations.
That was Senator Mark Warner, a Democrat from Virginia, unveiling a new bill titled the Restricting the Emergence of Security Threats That Risk Information Communications Technology Act. That's a mouthful, but let's be frank. This is essentially the TikTok bill, opening the door potentially for a ban of the Chinese-owned app. What's been a bad sign for TikTok lovers, though, has been the opposite for social media investors. Snapchat and Meta both extending gains today. Here to break down what this could mean for social media stocks is Mark Mahaney, Evercore ISI Senior Managing Director, Head of Internet Research. Good to see you, sir. First, just what do you think the likelihood is that we actually get somewhere near a TikTok ban?
Well, I don't know if I have a really well-informed political calculus on it. I assume it's not a majority, or I assume it's not a probability, not greater than 50% chance. But clearly it's been rising over the last 18 months. The risk of some sort of TikTok ban has gone from low single digits to something in the double digits. So it's really hard to handicap. But it is material, as you just pointed out. For what matters for stock pickers is this an issue like this is material for Snapchat, for Meta, and for Alphabet. And by the way, even if the asset doesn't get banned, because what's going to matter are there's negative publicity around TikTok, and it's going to be an issue for advertisers. So marketers at the margin are going to be somewhat hesitant about putting incremental ad dollars on a platform that could possibly be banned. And not only that, has sort of an increasingly negative stigma associated with it.
That's interesting, Mark. So you're saying some of these other competitors out there, some of the U.S. tech giants, could potentially benefit even without a full-out ban. When it comes to the government cracking down on tech, yes, this is foreign tech, but how are you looking at this from an analyst perspective and what that might mean here for the social media giants, which we know have also been under pressure from lawmakers over the next couple of months or potential couple of years?
Well, I'll make a few observations. One is that those who thought that were arguing a case that Facebook needed to be more aggressively regulated several years ago because it was a dominant social media asset, I think TikTok kind of undermined that thesis. You come up with a great social media platform, and TikTok has been hugely innovative. Anybody who has, youngsters around the home, hopefully, teens or higher, knows just how exciting, interesting, and entertaining TikTok is. And, kudos to them. They created a really popular app, and they got billions of people to use it. My hat's off to them as an innovation machine. There are two issues that have been brought up here. There's a national security issue, which social media assets in the U.S. don't face in this sort of way. And then there's also the social impact, which companies like Snap and Facebook have faced. So there's a variety of cross currents that are going on here. I just want to kind of stick with the point that social media is a relatively competitive space. By definition, we've had this monster asset called TikTok really come out of nowhere. And if you had an asset that was somehow limited in its appeal, that asset this popular, those people that are using it now are going to go somewhere. And our guess is that the biggest beneficiaries, it's almost impossible not to say it's Meta and it's Snap.
And that was, everyone's been trying to emulate TikTok for the better part of 2 or 3 years. Who is the closest to doing it and therefore monetizing it? And what about Google in terms of what they've done with YouTube Shorts?
Yeah, and I'm sorry, I should have mentioned Google is obviously a positive derivative here too. The two assets we think based on survey work that are most similar to TikTok would be YouTube and Instagram in the form of lean back or even interactive entertainment. Facebook's got a somewhat different demographic, and it's a lot more about community and friends and family. Instagram is much more of a kind of a open entertainment network, and so is YouTube, by the way. people have wondered, Twitter's a vastly different asset than this. And in core Google is almost nothing to do with TikTok. But you actually make a really interesting insight. TikTok exploded the popularity of short form video, so everybody copied it. Facebook and Instagram have Reels. Snapchat has an asset whose name escapes me now, but it is there on the right side of the screen. And then YouTube has Shorts. So yeah, there's a great, it turns out, I'm not sure this is good or bad for society. I worry that it's a little on the bad side, shorter and shorter attention spans. But the market, consumers, we love short form video. TikTok proved it to us. And so other companies have been very good about copying what was really great innovation. Credit to them, ultimate credit to TikTok, but credit to these companies for coming up with things, these sort of spin-offs. And by the way, it's really helped them fundamentally. So even forget about what happens to TikTok. Facebook has seen an increase in its engagement, the amount of time that people spend on a site, precisely because of Reels. It's been very popular and very effective for Facebook. And my guess is that it's going to be very popular for Snap. And my guess is that YouTube Shorts is building out greater interest in YouTube. So it's kind of a win all across the ecosystem, even if TikTok isn't banned.
So, Mark, the threat from TikTok has certainly been a common theme amongst a lot of these social media players, as well as layoffs. And there was a report today from Bloomberg that Meta is planning to lay off thousands of more as soon as this week. Just what's your takeaway from the report and the layoffs that are still to come within the tech sector?
Well, we've had a lot of layoffs for a couple of different reasons. One is that I think large swaths of tech overemployed, overhired, overbuilt. I think in part over extrapolated from kind of the demand trends that came out of COVID. But I think there's probably kind of creeping, I don't know what the word is, creeping, not imperialism, it's creeping organizational. It's almost like a vanity metric. The more people that you had working in your division, in your segment, in your group, in your company. And so I think you've had some of these companies just way overhired. And what they're finding is that they can maintain the same sort of growth if they cut out some of their employees. Look, job layoffs are always challenging and they're not fun for anybody. I've gone through it. These are painful moments for companies and the people who get laid off. But there's no doubt in my mind that there was some overhiring that occurred. And then you also had softening macro trend. So people overhired going right into a soft recession. At least that's a fair way to describe it. A soft recession where demand is kind of coming in. So anyway, that's what's behind these layoffs. My guess is that you'll see more. One way to do it is look at who grew their revenue the most and who grew their operating expenses the most. And the companies that grew their operating expenses faster than their revenue, that was Facebook, that was Amazon. Those companies needed to take the steps that they're taking now, and they'll probably have to keep cutting a little bit more. But I think all of this is a great setup for investors. I'm tactically constructive on the internet sector, consumer tech this year, precisely because I think estimates and multiples have been de-risked, but also because these companies have taken mature, belt tightening measures. We all tighten our belts when we go through a recession and incomes fall short. Companies need to do that too. They're doing that. And I think it's creating more of an EPS growth, what I call an EPS slingshot opportunity on the other side of this.
All right. Mark Mahaney, Evercore ISI. Good to see you, sir. Thanks so much. Coming up, Rivian shares are taking a hit after the company said it was going to raise $1.3 billion through a sale of green bonds. What exactly are green bonds? Shauna will tell us after the break.
Sound the finance jargon alarm. The term green bond. It is in the news today after struggling EV maker Rivian revealed plans to raise $1.3 billion through the sale of them. So what are they and why should you care? Well, we are going to tell you the sustainable objectives of green bonds is what sets them apart. They allow companies to raise funds for new and existing projects that benefit the environment. Think sustainable and socially responsible programs that reduce emissions or address environmental issues. And it can be across a number of sectors. We're talking clean transportation, like Rivian. We have sustainable agriculture, think John Deere, and also renewable energy, solar panels. Think Tesla there. The list can go on and on and on. Well, the appeal is that green bonds allow companies to fund the transition towards renewable energy and sustainability at a lower cost. So the rules of green bonds can be broken down into 4 parts. Let's go through them. 1, they must be used for green projects. Also, the issuers must lay out criteria used to accept proposals. They also must track the proceeds to improve that proper use and also share information about the proceeds used and also the impact of those projects that were promised. So who can issue them? Well, a number of institutions, governments, nonprofits, banks, and of course, corporations like Rivian. But Rivian is far from the only company that has issued green bonds this year. That long list includes 1, the media giant Comcast. They had a $1 billion green bond issued earlier this year. And also North Face and Timberland owner VF Corp, more than $500 million green bond that was announced within the last week. So certainly a trend that we are seeing, and the rising popularity of green bonds is something that you need to track. All right, well, coming up, we are counting down to the closing bell on Wall Street, the final minutes of what looks like an ugly day for the street. We have the Dow off 577 points. We'll be right back. Okay, that is the closing bell on Wall Street. Let's check in on the markets, how we are closing the day. Sponsored by Tasty Trade. You're certainly looking at losses across the board here. The Dow closing off just around 573 points. The S&P off 1.5%. The Nasdaq also ticking lower here in the final hour of trading. Stocks really selling off following those comments that we heard from Fed Chair Jerome Powell. We could be in this higher interest rate environment for a longer period of time, and more rate hikes look to be on the table. Jared Blickery standing by at the big board here with a closer look at the selling action, Jared, that we did see throughout the day.
Yes, nasty day here. Nastiest day for the Dow and S&P 500 in a couple weeks. So let me just show you what's happened today. This I'm going to put on a one-year chart. chart so I can put some trend lines on in here, but we came just about down to the bottom of this trend line right here. So don't want to puncture that. Right here is a 200-day moving average. So in other words, a lot of damage has not been done yet. However, we're going to be on alert for the potential of that. Also want to show you the 13-week and the 10-year T-bill and T-note yield, I guess, in the bond market. Now, the 10-year is only down about 1 basis point, but let me show you what's happening to the 13-week, which really tracks what the Federal Reserve is doing at the short end of the curve. That is up 12 basis points. And if I show you some candlesticks here over the last 3 months, this really stands out. Higher, yes. For longer, remains to be seen, but definitely higher for the time being. Now, let's check out some of our heat maps here. This is the Nasdaq 100. And despite the nasty tape today, we really didn't have a lot of dark red or dark green. Now, a few standouts. We got Tesla down 3%, AMD up 1%, a few others interspersed here, but not a lot of extreme selling. So that's the good news. Let me take a look at our sector action first. Everything in the red. Staples, the best off of everything. That's down about 1%, but financials really taking a hit. That has to do with the bond movements and the expectations that the Federal Reserve, Jerome Powell, going to choke off the economy. The financials really going to take the brunt of that. Real estate, also very interest rate sensitive. That is down 2.5%. We can go down the line. Materials, energy, you get the point. Let me show you the banking sector right now, because this is going to be in focus tomorrow as Powell takes the stand. All right, well, I guess he's going to be sitting in front of the Senate. But here is some negative tape for you. Here's Bank of America, that's down 3%, Wells Fargo 4%, Goldman Sachs 3%. So this is going to be in focus along with the bond market tomorrow, and I'm going to be watching.
We all will be watching. All right, Jared Blickery, thanks so much. Well, you mentioned it there. One of the reasons why we are seeing so much red here on the boards is the comments that we got from Fed Chair Jay Powell's testimony on the Hill earlier this afternoon. What did he say that worried investors? Yahoo Finance's Jen Schomburger has a look at that for us. Hey, Jen.
Good afternoon, Shauna. That's right. Fed Chair Powell testifying before the Senate Banking Committee earlier today, suggesting that inflation is running higher than expected, and thus it's likely that interest rates will need to be raised higher than previously thought. Take a listen.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
The Fed projected at its December policy meeting rates would need to rise to a range of 5 to 5.25% this year, though Powell now suggesting rates will need to be raised higher than that, and policymakers will pencil in just how much higher at their meeting on March 21st and 22nd. While Powell said policy decisions would be made on a meeting-by-meeting basis, he noted that if the data indicated that faster tightening is warranted, the Fed would be prepared to increase the pace of rate hikes. Indeed, the market glomming onto that, Powell's comments spurred traders to price in a higher chance of a 50 basis point rate hike rather than a 25 basis point rate hike later this month. Meanwhile, in questioning, Senate Republicans focused on the Fed's reassessment of banks' capital requirements, while Democrats took Powell to task over rate hikes leading to job losses. In a contentious back and forth, Democratic Senator Elizabeth Warren accused the Fed of putting 2 million people out of work with rate hikes. Powell responded, "Will working people be better off if we just walk away from our jobs and inflation remains at 5 or 6%? Meanwhile, Senator Cynthia Lummis asked whether stablecoins have no place in the banking system. Powell replied that stablecoins that trade on public blockchains are susceptible to fraud, but if properly regulated, as comparable products are, could have a place in banking. Guys?
Jen Schomburger, thanks so much. We'll talk to you again tomorrow after the House aspect of this. Let's take a look now at Salesforce shares closing the day near the flat line on the heels of the company launching Einstein GPT, which it says is the first generative AI customer relationship management technology. Here's what Salesforce CEO Mark Benioff told us about the project last week.
Einstein is our core artificial intelligence platform at Salesforce. You know, we are the leaders in artificial intelligence and CRM and commerce. We've delivered incredible results for our customers, making sure that when their customers are online buying from them, we're able to provide an artificial intelligence framework that we've been developing for a decade that is really incredibly state-of-the-art.
So while Einstein may be new, Benioff noting they are not new to this space. He's been at it for a long time, something we heard from several companies as ChatGPT has risen to prominence. Benioff said ChatGPT 14 times on their earnings call. And to boil this down in its simplest terms, it's allowing Salesforce customers, Shauna, to Slack Einstein questions, and it will then give them answers based on Salesforce data. No information on what the pricing is or the timing is until they work out the kinks and, of course, the morality issues that some are wrestling with chat.
Yeah, and I think that this is just the latest player. We're going to hear this announcement from more and more within the tech space in terms of just the focus on AI. We know Salesforce has been under a tremendous amount of pressure from activist investors. I'm not saying that's why this announcement came out today, but certainly Salesforce, though, looking to really be among the leaders within this space, certainly riding the coattails, what has been very successful here for Microsoft, or viewed as successful over the last several weeks, their entrance into ChatGPT and how they have positioned their company right alongside of OpenAI. I think OpenAI is a clear winner in all of this. You have another massive tech giant that is using some of your technology coupled with their own. The more and more users out there obviously will enable OpenAI to have more reliable data. We know that has been something, more reliable information, I should say, that we are getting from ChatGPT. That has been something that has been in question out there. But now we have Salesforce, we have Microsoft, we have Google with Bard. Meta was talking about their AI initiatives, what they're doing there in terms of their language models for AI. Snapchat also jumping on the AI train with their social media chatbot. The list goes on and on and on.
But to the point, they've all been at this for years, if not a decade, and this is to please investors, get a little buzz, and clearly it is working. Now, that's not why Salesforce is up 36% year to date. That's because they had a tremendous earnings report. But look, you're going to hear this from every company. You mentioned one winner, which is, of course, OpenAI, Microsoft back. C3 AI up 130% this year. Their CEO says this is soon to be a $600 billion addressable software market. That is mind-blowing.
Mind-blowing.
Which do you like the name of, though? Chat, Einstein, or Bard, if you had to pick one?
Chat.
Really?
Yeah.
Okay, I like Einstein, actually, because
maybe it'll grow on me.
ChatGPT is hard to say. Now, it is Einstein GPT, but I think it's how you package it.
Really?
If it was just chat, I'm with you.
Okay.
But ChatGPT just doesn't
I was
roll
going to say,
off the tongue.
earlier today I was having problems. I kept saying Einstein ChatGPT, which clearly that is not it. So I need to
agree
work.
Bard is the loser.
Maybe Bard, yeah, maybe Bard. Maybe
Sorry, Bard.
All right. Well, we are also watching Apple today. Now, shares did close lower, off about 1.5%, along with the broader market, some of the pressure that we did see across the tech sector. But we want to talk about one of the headlines out from Apple today, and that is news of what is on the right-hand side of your screen right there, a bright yellow iPhone. Now, the color is going to be available for the iPhone 14 and 14 Plus lineup. Maybe this will help Apple boost sales here. The company reported an 8% year-over-year decline in iPhone sales for its last quarter. We know iPhone sales are so important for Apple, although that narrative's starting to shift with more of a focus on services. But even when you take a look at the numbers, clearly they make up more, iPhone sales makes up more than half of Apple's revenue there. Apple relies heavily on the success of its iPhones. They need to do something. Whether or not the yellow iPhone is going to do the trick, I'm not totally convinced, but I like it. It's bright.
They
it's
do it every
springy.
spring.
It's a good mood. I'm all about it.
I love the yellow.
Yeah.
I'm a huge fan of my initial reaction. That is an outstanding color, really gives you some pop. But then I thought, wait a minute, who cares in this day and age what color your iPhone is, because they're so fragile. It's the most expensive thing we own for the most part, other than our car. And they're so breakable. We all have to have cases, these big unbreakable cases. So we asked you, do you care about the color? Do they matter anymore? Because they're so fragile and because you need a case, 81% overwhelmingly said no, it does not matter. So that would lead you to believe this is not a huge investor story when they come out with a new color.
Yeah, I don't think it's a huge investor story. As you were talking, I was trying to remember whether or not I know the color of my phone. I have no idea what it is underneath my case.
I do think mine is blue. No, it's black because I didn't care. I didn't care. That's a good point.
Yeah,
now, this is not the Pro models.
Black too. Yes, that's important
So
to point
that's important to note. You can get your hands on it March 14th in store. You can pre-order on March 10th. Yes, I have a Lion King iPhone case, which is one of my favorite sayings of all time.
It's a great saying. You should never switch that.
I never will. It's close to my heart. All right, coming up, the Justice Department suing to block the JetBlue Spirit Airlines merger. Here with Merrick Garland, the AG had to say, and what it could mean for the United States airline industry when we come back.
The issue in the US industry, and this is where we agree actually with the Department of Justice, is that we've got 4 large airlines with about 20% of the market each. That's 80%. The rest of us have 20% between us. And so what we're trying to do is make a bigger JetBlue to bring the JetBlue brand, the JetBlue product, the JetBlue people, and the JetBlue fares more nationally than we can do today. This is not Pepsi buying Coke. Together, we're going to be 8 to 9% of the market. You know, you said a fifth largest airline, a distant fifth.
That was JetBlue CEO Robin Hayes on CBS News this morning. JetBlue and Spirit Airlines are going to have to sit on that runway a while, awaiting takeoff, after the Department of Justice filed suit today to block JetBlue's $3.8 billion acquisition of its low-cost competitor. You can see the shares there of JetBlue. They fell again almost 3%, while Spirit Airlines up almost 5% on this news. When, if, and ever will this deal take off? Let's discuss with City Managing Director of America's Airlines, Stephen Trent. Stephen, good to see you, sir. What do you make of that argument from Robin Hayes? This ain't Coke buying Pepsi, and they're about 8 to 9% of the total market after this acquisition, nowhere near the Big Four.
No, and good afternoon, and thank you for having me on. I actually think that comment makes reasonable sense. Market share of the Big Four is massive, and when one looks at the government's argument about some consumers losing low fares, yes, that's true to some extent. That the argument that you'd be taking roughly 50% of U.S. ultra-low-cost capacity out of the market, but that's at least partially predicated on the view that rival ULCC Frontier Airlines is not going to be able to expand into any of those ex-Spirit routes. And at the same time, JetBlue becomes a bigger competitor. Do they arguably start competing more aggressively against the back cabin of American Airlines, Southwest Airlines? So this view that nationwide there'd be a big move to higher fares across the market, I'm not necessarily sure that's true. I have some doubts about that, but we'll see what the courts eventually decide.
Well, Stephen, while laying out the Justice Department's case for blocking this merger, AG Merrick Garland did cite some specific examples, saying that this merger would lead to an outsized hole on some specific routes. Let's take a listen to what he had to say.
On the Boston, Miami, Fort Lauderdale route, which serves about 1.5 million passengers annually, JetBlue and Spirit together currently account for nearly 50% of the market. For service between Boston and San Juan, the two airlines account for nearly 90% of the passengers flying the route today. And on some routes, JetBlue and Spirit are the only two carriers providing nonstop service. Eliminating the competition between JetBlue and Spirit on these and other routes would eliminate Spirit's unique and disruptive role in the industry and significantly harm consumers.
So, Steve, the Justice Department there arguing that this merger could potentially hurt consumers, could potentially drive up prices, especially on some of those specific routes. Do you think they have an argument there?
So you can look at different routes, and will there be an impact on some routes? Absolutely, there will. I would still argue, though, there's a difference between saying there will be an issue on some routes and saying there's going to be an issue across the entire network. So can the courts and the Justice Department get to some kind of middle ground or common ground, per se, where JetBlue and Spirit would need to relinquish capacity on some routes? I think that's not unreasonable. I'd just be reticent to pick 2 or 3 routes where the combined carriers have a lot of capacity, and then based on what's happening on those specific routes, ding the whole merger. I'd just be a little anxious to not cherry pick and use examples where the combined carriers would have a lot of capacity.
Yeah, Merrick Garland knows the law better than me, but if you're citing routes to San Juan as your central case, it is, relatively speaking, thin. The JetBlue effect that Robin Hayes actually talks about is he has evidence showing when they come to a market, flights increase, prices go down. But I do want to ask you about the ups and downs of the stocks, and particularly what we saw today with Spirit taking off. More about 4.5%, and JetBlue continuing to come in for a landing, if you will, because I'm not done with the puns. Is that the story that we'll see moving forward if this acquisition is denied, blocked?
Yeah, no, great question. And I do think that to some extent it's possible that today's price action was somewhat of a reversal on yesterday's price action. So when there were some feelers out there in the market, for example, that the government was going to sue to block this thing, I think that was kind of a premature move, a knee-jerk reaction, so to speak, from the market. So the price action we saw today, Spirit Airlines was up a lot, and it recouped, reversed a lot of the loss that it saw yesterday. And JetBlue relinquished some of its gains. So I would expect today's price action to be somewhat more in line with what we could eventually see, let's say, from the courts approving the merger with conditions. So Spirit Airlines gets taken out, JetBlue, there is maybe some risk built into the stock around integration, and the amount of capital it's got to fork over to the Spirit shareholders. So, logically, today's stock price reaction made more sense to me.
Steve, I know you're not saying that this is the most likely scenario, but if in fact it is blocked, who's the beneficiary? Who's the winner of that?
Sure, absolutely. So we said in some recent work, for example, that a JetBlue would probably see a price jump exactly as we saw in the shares yesterday, because I think there would be some indication from the market that they have dry powder in terms of potential capital deployment. So I think if on the opposite end of the spectrum, if you're Spirit Airlines, then maybe there's not going to be any takeout. And if that is the case, then it's conceivable that the shares would trade back down to historical pre-pandemic averages. So, under that scenario, if the merger gets blocked entirely, at least on a short-term basis, it's beneficial for JetBlue shares.
But Steve, what about outside of JetBlue and outside of Spirit? Frontier, Southwest, Delta, United, American. Which one of their competitors out there is best positioned to capitalize on it?
Oh, absolutely. So if you're Frontier and this merger goes through, you're potentially going to be the only US-based ultra low-cost carrier. So you're going to go in there, possibly have opportunities to expand where your ULCC competitor has been eliminated. You arguably have much stronger seat mile cost profile than any of the competitors above you. So you go into those routes. And we think the other winner of a JetBlue Spirit merger is indeed Frontier Airlines. If the deal falls apart, it's really hard to say what's going to occur. If Spirit Airlines shares suffer enough, does that mean that Frontier is going to come back into the mix to maybe make overtures to Spirit as we saw at the beginning of last year? That's hard to say. And I think if you're American Airlines or Southwest, it's possible that, and I pick on American rather than Delta or United because American of the big three has the most domestic exposure. So if you're a JetBlue, for example, a combined JetBlue Spirit Airlines possibly becomes a more dangerous competitor for an American Airlines in the rear cabin on those cheaper seats. And maybe at the same time, Southwest Airlines, for example, which is chiefly a domestic carrier, arguably also faces more competition from a bigger JetBlue.
All right, great stuff there. Steve Trent, thanks so much for breaking that down for us. Well, coming up, Oscars are this weekend, and the summer blockbuster season around the corner. There's lots of excitement in Hollywood. We've got IMAX CEO Richard Gelfond joining us in studio next. Let's do a quick check on the markets here where we close the day, sponsored by Tasty Trade. Dow closing off 574 points, S&P off just around 1.5%, the Nasdaq off just over 1% as well. All right, a huge night ahead for Hollywood with the 95th Academy Awards this Sunday, and one of the biggest movies of 2022, Top Gun Maverick, was shot on IMAX cameras, and IMAX's highest grossing film of 2022, Avatar: The Way of Water, is up for 4 awards. Certainly a huge weekend, not only for Hollywood, but more specifically for IMAX. So we want to bring in IMAX CEO Richard Gelf on, Yahoo Finance's media reporter Alexander Canal, also joining us here with this conversation. Richard, it's going to be a huge weekend for you for IMAX. I mentioned Avatar: The Way of Water, Top Gun Maverick, 2 films that were shown in IMAX theaters are up for a number of awards. What do you make of this shift that it seems that we are seeing more of those blockbuster films getting nominated this year, and what does that signal for Hollywood?
Well, I think it's a really good thing that it's happening. I think over the last few years, obviously accelerated by the pandemic, but I think Hollywood a little bit lost its way with the Oscars, and I think it was a little too much inside baseball, and it was a little too much streaming movies. And guess what? The public likes going to theaters, and movies exist in theaters. When I was more hostile about this years ago, I've calmed down and said a lot of these things that were nominated for Oscars were like the old movie of the week kind of thing. But I think this year's movies are a lot more like old-fashioned movies. Big special effects, big stars, big cultural events, global events in the world. And I think if the Oscars want to remain relevant, they needed to move back to that direction. I think it's great they're doing it.
And if we think about the state of Hollywood right now, you know, Top Gun Maverick, Creed 3 just released this weekend, gangbuster opener. They were both shot on IMAX cameras. Avatar has done so well. But all of these movies, they are franchise movies, right? They're these action-packed sequels. Clearly, that's been great for your business. But do you think that's a sustainable strategy moving forward across the theatrical ecosystem?
Well, before I answer that question, I would say I don't think these were traditional kinds of sequels, because remember, Top Gun was 37 years ago, so almost no one was born who saw it again. And even Avatar was 13 years ago. So I think those don't really count for sequels. I think other things, other kinds of movies count. And I do think it's partly sustainable. I think you need new IP and fresh kind of content and fresh stars to really create longevity in the business. But I think there's definitely an appetite. I think Hollywood has sometimes gone too far. I used to joke and say, if a tornado movie worked, they'd say, green light another 2 tornado movies. And then when the third one didn't work, they'd say, fire the idiot who greenlit the tornado movie. So I think within reason, and as long as they're novel, they're good things. But I think the trend was kind of overdone. I agree with you on that point.
Yeah, and if you think about earlier this year, Megan, for example, that was a breakout one that people didn't expect, but folks are still going to the movies. But let's talk about the overall movie-going experience, because it is expensive. We crunched the numbers here. Let's say we wanted to see Creed 3 tonight in an IMAX location at AMC in New York City. 2 people would shell out around $83 for 2 tickets, a large popcorn, and 2 regular soft drinks. So how do you really convince consumers that this premium experience is worth that price when I could buy some IMAX enhanced technology, put it in my home, have a nice little setup on my couch? What's your argument there?
Well, my argument is, compared to other forms of entertainment, it's still relatively cheap. If I asked you to crunch the numbers about going to the Yankee game and having 2 beers and some popcorn there, or going to the Billy Joel concert at Madison Square Garden, or going, you know, to a big event in New York, going to a Broadway play, right? That's now $150, $200 a ticket. It's still a bargain compared to other forms of entertainment. And the difference in going to IMAX is it takes you to another place. If you go to Yankee Stadium, you've seen the Yankees. It's 162 games. You've seen baseball before. But when you see Avatar, you're going to another world. Or you see Top Gun, you're flying in those F-18s with Tom Cruise. And also the laughing. I just went to the Creed premiere in LA, and I don't want to, no spoiler alerts, but in the fight at the end, I mean, people are screaming. You're really into it. I think it's more immersive than a lot of things. By the way, You don't have to buy the popcorn. It's a little
That's
fat
true.
anyway, so you could save the money there.
There you go. New Year's resolution, skip the popcorn at the theaters. Richard, real quick before we move on here, sticking with pricing, that new pricing tier that AMC rolled out, paying more for specific seats. Just in terms of how do you view that as an insider within the industry? Could it potentially have a downside risk to that?
It can, and it's been done before. In Europe, people have done it. I don't generally like it because I think it's like saying one seat's better than the other seat, and I think it's tough to enforce, and I don't think you make enough money to create the complexity. And suppose I bought a cheap seat and I moved to another one. What do we do? Get in a fight in the middle of the theater? I'm not a big believer in the plan, so I kind of agree with you.
Richard, I want to switch gears to a big announcement at your company. IMAX has named 2 female board members, Elvis producer Gail Berman, Reddit COO Jen Wong. This is a big deal at a time when we don't see a lot of female representation on boards. And before this, you only had 1 female board member, Dana Settle, out of 8. Why make this decision now, and how do you think it's going to drive your business moving forward?
I think we've done a really good job of diversifying our company and our management. I think we've done a less good job at diversifying our board. So we actually went out and we made a concerted effort to say we want more diverse candidates, but instead of finding 1, we found 2. So we said, why not? So Gail she used to be president of Paramount. As you said, she did Elvis. She's involved in Wednesday now. So I think she could bring a lot of expertise to our Hollywood slate and the constituency that we operate with. And Jen is very senior at a technology company with a great background, and I think social media, Reddit, and I think we thought we could use that expertise. So it wasn't only that we found candidates of diversity, we found 2 really good ones, and we thought they could help our company.
Do you think this is an issue within the entertainment industry at large, this lack of female members on boards?
You know, I'm not familiar enough with what other people do, but it was an issue with us, and we fixed it.
Yeah, certainly a very important step to take, and I know a lot of people commend you guys with that. Well, Richard, while we have you, and we have you in studio, we thought it would be fun to play a little game. Now, in honor of the Oscars coming up this weekend, we're going to have you give out Richard's Award. So we'll go through a couple different scenarios and get whatever your opinion is on some of these movie-themed questions. You can, I guess, give your honor, your pick of some of your favorites. Let's kick it off here with your favorite movie of all time. A tough question.
Of all time, Chariots of Fire.
Okay.
That was really quick, Richard.
That was very quick. All right.
Oh,
Okay.
it's easy because I love the movie.
All right, the movie you're most anticipating this year.
This coming year, Oppenheimer. I think it's going to be amazing. And Chris Nolan filmed it with IMAX cameras. And part of it was in the trailer, part of the tests before the Manhattan Project. It looks incredible.
Wow. And when does that come out?
July, late July.
Okay, so a couple months away from that. All right, so that's movies. What about TV shows? What's your favorite?
Succession. It reminds me too much of Wall Street, but I like it.
Well, our very own Dave Briggs makes an appearance in Succession. He's one of the anchors in the show this season, so you got to check it out.
I got to see that one, for sure.
All right, well, let's move on to concession snacks. You said you didn't need to get the popcorn. What's your favorite concession snack?
Popcorn.
Okay, there you go.
There you go. You got to get the popcorn, the soda, movies would not
I
be
like
the
the
same.
Twizzlers. My wife loves the Twizzlers.
Oh, the Twizzlers, that's good too. Yeah, you got to get something sweet too. Okay, most iconic song choice in a movie.
Most iconic song choice. That's a tough one. I'm thinking of Apocalypse Now. I don't remember. I think it was Stones. I'm not positive. Maybe it was Painted Black, but I love the way that played. Oh, and another one is in Live and Let Die, in the Bond song, Paul McCartney.
Yeah, that's a good one. Okay.
Armageddon is the one I'm thinking of. What's the song? Forever, I want to hold my eyes.
That is it. Yeah.
Anyway, no one wants to hear me sing.
Ben Affleck.
Another Aerosmith. We have Dave chirping in the background here. Okay, this is an interesting one. Nicole Kidman AMC commercial. This went viral for a lot of reasons.
Right.
Iconic or forgettable?
I'll get killed by my partner AMC, but forgettable.
Oh, okay. This is one I think is a no-brainer. Feet on the seat in front of you at the theater, feet on the ground. You got to put the feet on the ground.
Feet on the ground. Completely agree.
You
with
gotta,
you.
yeah.
Reach for the stars and keep your feet on the ground. There it is.
That's a good one.
This is related to recline or not recline.
Definitely not recliners.
Wow!
IMAX was not built for recliners. IMAX was built for people who love movies. And when you're lying on your back and you're kind of looking, and by the way, the kid next to you is moving the seat up and down, that's not the way to watch a movie.
Okay.
That's probably my kid in the theater. All right, 2D or 3D?
Depends on the movie, but mostly 2D. I think certain kinds of movies, like Avatar, obviously, were made for 3D, but most movies were made for 2D.
Okay, interesting. And your final question, your favorite dance scene in a movie?
Dirty Dancing.
Yeah, gotta
That's
be
easy.
that.
Come
It's
on,
easy.
there's no other
Dancing.
choice.
Okay, mine was Grease, the final
that's a
scene
good one.
at the end.
Oh,
Love
can I
that
tell you
one.
something? When we opened our theater in Sydney, Olivia Newton-John was there to open it, and I actually got to dance some of those songs.
Did you really?
It was a life memorable moment.
Do you have video of it? I'd love to see it.
I don't think
God,
they
we
let
gotta
me.
show that next time.
We're going in the archives for that.
All right, Richard Galfond, CEO of IMAX. Thanks so much for joining us here.
Thank
in
you,
studio.
guys. Thanks so much.
And of course, our thanks to Ali Canal as well. Well, coming up next, the battle over the next NBA media rights package is quickly approaching, and ESPN and Turner are going to face new competition from streaming platforms. Find out who could emerge as the biggest winner when we come back.
Sports media rights were a $55 billion business in 2022, and that eye-popping total will reach $60 billion by next year, according to the Sports Business Global Media Report. The next rights jump ball is the NBA deal, which expires after the 24-25 season, but who will retain possession? Jessica Reif-Ehrlich is the Bank of America Senior Media and Entertainment Analyst. Joins us now. Nice to see you, Jessica. Thanks so much. So how much do you believe the NBA is seeking in this new deal?
The speculation is that the rights deal will be at least 100%, if not 200% higher. So 2 to 3 times the current package.
So ESPN and Turner currently control the rights. Do you believe they are the favorites?
You know, incumbents usually are the favorites. They have an exclusive negotiating window. They also have the right of last refusal. So it's highly likely they will keep the rights, but it's a negotiation. And these are incredibly attractive rights. The NBA has a long season, which actually fits really well with ESPN because it gives them year-round programming. It's very important programming for Warner Brothers Discovery as well. It's on Turner. So they obviously want to retain those rights. There's speculation that there are other traditional media companies that want those rights, but we're fairly sure that there will be a FANG company coming in, whether it's Apple, Amazon, or one of the others, we'll see. But they have been increasingly involved in sports. You see Amazon with Thursday Night Football, Apple with Major League Soccer. And so it's a big driver for their own streaming platforms.
I do want to follow up on that, but first, Warner Brothers Discovery has tens of millions tied up in their talent with Charles Barkley and Shaq and Ernie Johnson. Could that influence their decision? On the other hand, the other favorite is Disney, and Bob Iger has really suggested cost cutting is central to them. So how does that impact both of their chances or desire to move forward?
Well, just in streaming in general, all of the companies, certainly the traditional media companies, but Netflix as well, have a focus on cost containment and allocating to the most important, allocating their resources to the most important content. The NBA is clearly highly desirable. There's a very young audience. Sports betting is driving viewing. Sports ratings are up a lot. And so you have sports betting, it's part of the pop culture. And as these companies transition from linear to digital, it's a really great kind of segue for them. It's, where they can straddle. You see that with the NFL. All of the traditional media companies also have digital rights, but it's also important for the NBA. Yes, it's fantastic programming, but it's important for them to keep their fans and especially to attract younger viewers. So they have to have a way to reach them. And with the decline in linear, you have to have reach, so you need linear. But with the continuation of cord cutting, it is important to have some streaming options, some digital options. So obviously ESPN, ESPN Plus, and Warner Brothers Discovery and HBO Max, they have those streaming options. But given the speculation of how much this package will go for, we just view a third party coming in as highly likely to make up the difference. Yeah. And if you look at all of the sports that have been renewed over the last few years, everything's gone up, double or more.
Yeah, the number out there between 50 and 75 billion. The outsider or newcomer, Comcast via NBC, how serious a competitor could they be?
Well, Comcast has all the assets that are desirable. They have a broadcast network in NBC. They have cable networks in all of the NBCU networks, NBC Sports, and they have streaming through Peacock. So they have it all. The problem for Comcast is that it would be a major step up for them. So for Warner Brothers Discovery and Disney, it's a step up from the current contract. In a recent report we did, we noted that, at $1 billion increase for each party, for both of them, it's several percentage points increase or taken out of their EBITDA. But for somebody like Comcast to come in and to first bid, it would be a very hefty impact. It would have a very hefty impact on their total cost structure and would make a dent in their cash flow, in their EBITDA. So it's a little tougher for them to come in as a new player, much easier for the incumbents to just bid a little more.
Circling back to streaming,
we'll see.
Oh, apologies. And the dream scenario for the NBA, which is likely Amazon and Apple in a bidding war. We saw Apple grab the MLS and Amazon get in the NFL deal. Could that develop? And given what we saw with the NFL, saw a decline in Thursday night ratings on Amazon, do you think they'll put a priority on profits or on ratings? Revenue or ratings?
Right. But the thing with the NFL on Thursday, it started off a little bit weak. They had to learn the business, and it's gotten much better. So like now everyone's saying how fantastic Amazon's doing with Thursday Night Football, and they took over a loss-making contract from Fox. So Fox was losing $300 to $400 million a year on that, and Amazon bid a lot more. So it is a big driver of revenue for all of the sports leagues because the FANGs have bigger balance sheets and seem to be able to pay more. But it's important to consider reach as well, which is why we don't think it would just go to one or two FANGs. We do believe that the traditional players will be a major part of any new contract.
Interesting. The most recent media deal we saw was that huge deal from Google. They grabbed the Sunday NFL ticket package, rumored to be around $2.5 billion per year. We talked to Wedbush's Michael Pachter, what he thinks about that deal. I want you to hear what he had to say.
Live sports is a hook to keep someone subscribing. So
it makes sense for a cable provider, for Comcast, and it makes sense for a retransmission company like CBS or NBC to buy sports rights. I think Google's going to fail miserably with the YouTube purchase of Sunday Ticket. I think that's going to end up being a disaster for them.
Do you agree with that? And will that teach Amazon or Apple a thing or two about the cost of these media rights?
It's really hard to say. You have to see they're going up a learning curve, and the FANGs typically don't have the production expertise. I think Amazon is still using NBC for production, but they, as I said earlier, they have much bigger balance sheets. But it's true. The first part of the comment was sports drives advertising, it drives affiliate fees, it does keep viewers engaged. Ratings are actually up pretty dramatically on NFL. So it is really important programming. So if you are trying to establish a beachhead, then it's critical programming. It's impossible for me to say what Google's long-term ambitions are in video and what they plan, how they plan to develop their service.
Going to be a fascinating watch to see who gets these NBA rights. Jessica Reif-Ehrlich, Bank of America, thanks so much. Appreciate it. Coming up, earnings season is winding down, but there are still plenty of companies reporting after the bell. We'll bring you some of the biggest after-hours movers next.
All right, let's take a look at what is trending after hours. Two names for you, CrowdStrike and Stitch Fix, both out with earnings. Let's kick it off with CrowdStrike. You're looking at gains of just about 6.5% in extended trading. The company beating on both the top and bottom line. Also, its Q1 guidance coming in strong, better than expected. The cybersecurity play, clearly seeing the benefit of that in after hours trading. Over the last 3 months, we're looking at gains of just about 10%. But over the last year, CrowdStrike has been under pressure along with many of its competitors in the cybersecurity space. We're still looking at losses of about 25% over the last 12 months. Let's flip it over to Stitch Fix, another name on the move here in extended trading, off just about 2.5%. A number of headlines here from Stitch Fix. Now, the retail player, weak outlook, executive shakeup. They also missed on both the top and bottom line for their fiscal Q2 second quarter. That is what they just reported. Their new CFO will be effective as of April, so executive shakeup there. Q3 and full year revenue guidance also coming in weaker than expected, short of what the street was looking for. We're seeing that pressure in extended trading over the last year. Stitch Fix off just about 52% year to date. We have certainly seen a lot of gains. Stitch Fix, one of the names that have certainly taken off since January 1st. Some of those beaten down names of 2022 in favor at the start of 2023, and that stock up just about 59% year to date. Closing though below $5 a share. So you got to put it all in perspective there, Dave.
Indeed you do, my friend. Thank you. Cleveland, Ohio, famous for a few things, most notably brown water in the Cuyahoga River, the Rock and Roll Hall of Fame, and being home to LeBron James. Sort of. Technically it's Akron, but it's close enough. But now Cleveland can claim to be number one, the best city in America for tipping. The only city, in fact, that averages over 20%. Digital platform Toast compiled the data, and you can see the top of the list is Denver, Salt Lake, Phoenix, Richmond, Chicago, New Orleans, and just making the cut there is New York. For the most part, I'd say the commonality of all of this here is we're just tipping too much. We're tipping not in terms of a percentage, but too many people. Everywhere we go, there's a cup, there's a little thing we got to sign. Even when I ask for black coffee, it's out of control. But I do applaud Cleveland. Nice job at being the most generous city in America.
I applaud Cleveland as well, although I want to point out, of the 8 cities that we did have up there, the top tippers, there wasn't a huge discrepancy. What New York was at the bottom of the list. Still, the average tip was 18.7%, which I would argue is good. I mean, I tried to tip 20% when I'm dining in stores. I don't tip the in restaurants. I don't tip the 20% when I'm getting my coffee or doing something like that, where it's a very, very brief exchange. Maybe I should. Maybe this survey result's making me second guess some of my tipping etiquette, my tipping behavior over the last,
Yeah, I actually thought most cities in that top 10 would be above 20%, because that seems to be the baseline now.
Yeah.
You don't see anyone really, no server is happy with a 15% tip these days. In fact, I would say they're downright offended. There have been a lot of viral videos lately about delivery drivers and servers who go to social media for any tip that's below 20%. It's gotten out of hand. You didn't answer what you tip when you pick up to-go food.
To go when I pick up to-go food?
When you pick up.
That varies.
Okay, me too.
Really varies.
But rarely is it 20%.
Oh, no. It's not 20%.
And how about delivery when you get Uber Eats, for example?
I try to be generous with that. I would say it's probably around 15%.
Okay, I do tip them 20% because there actually is some real effort there. When you're just picking it up in store, they move it about 5 feet, but a driver who's picking that up, putting it in his car, then walking it up to your house, a little more effort. But at least we agree, there's just far too many tips in this world.
Yeah, and obviously many of the tips are justified when you're talking about the delivery or if you're inside of the restaurant. If it's just a quick interaction, I don't think you deserve that 20%. But overall, according to the study, those tipping numbers did drop between comparing the 2022 numbers to 2021. Quick service restaurants average a 15.9% tip. That was a dip from over 16%, 16.4% the prior year. Full service restaurants on average was 19.6%, which was also a slight drop from 19.8%.
That's interesting. I wonder what that reveals about the economy.
Higher inflation, more costs everywhere.
One last question. My favorite restaurant now includes all parties, even to a 20% tip.
Yeah.
Would that offend you?
No, it actually makes it easier.
What if you get bad service?
Well, as long as the service is good. If the service isn't good, then I would take issue with it. But If it's your favorite restaurant, you have to be pretty satisfied with the service.
Yes, but I need room for bad service because I want you to know if you stink at, if you
How
give
often
me that
do you
service.
deduct for bad service?
Very rarely. You have to really do something that I know is your fault and not the kitchen's. I'm a former
What would that
waiter.
be, messing up the order? Oh, you're a former waiter.
I'm a former waiter, so I know when it's on you and then when it's on the kitchen.
Sounds like it must be the toughest job, one of the tougher jobs out there.
It is tough.
All right, well, it is closing time here at Yahoo Finance. Let's take a look at some of the biggest stories of the day. Stocks ending the day sharply lower after Fed Chairman Jerome Powell warned that the Fed may need to raise rates higher than anticipated in order to bring inflation down. Now, Powell telling members of the Senate Banking Committee that if the data indicates that the Fed is prepared to increase the pace of rate hikes tomorrow. Powell will be back on Capitol Hill again to address the House Financial Services Committee. We will bring you those highlights from that in tomorrow's show.
Hopefully the market performs better tomorrow. The Justice Department is suing to stop the $3.8 billion JetBlue Spirit Airlines merger. Attorney General Merrick Garland says that if the deal were to go through, it would, quote, limit choices and drive up ticket prices for customers. In a joint statement, the companies say they will continue to work on the deal, arguing that a combined company would create a strong competitor to the Big Four airlines.
And there are reportedly more layoffs coming to Meta. Bloomberg is reporting that the company behind Facebook and Instagram will be laying off thousands of more employees and could potentially start this week. Now, this would be Meta's second round of layoffs in recent months. In November, Meta cut about 13% of its staff as part of a broader cost-cutting plan. We should note that we did hear from several tech companies announcing layoffs just this quarter alone. Well, that'll do it for us today on Yahoo Finance Live. Thanks so much for sticking with us. We'll see how the markets open tomorrow. Maybe a bit of a relief rally. I don't know. All right. Well, we'll see you around the closing bell tomorrow, 3 p.m. Eastern Time. Have a great night.